So let's go ahead and get started. And as you will see, I'm going to talk today about making banking boring again. And we've been talking about building a better economy for a few weeks now. This really is a continuation of those topics. But I do think that what happened over the last weekend with First Republic Bank collapsing, what happened earlier this year with Silicon Valley Bank, and what appears to be really moving through the banking sector right now in terms of the fragility of especially mid-sized banks, and we'll get into this a little bit more, illustrates the problems with the approach to economic regulation characteristic of the last 40 years, but really also the New Deal approach to financial regulation in general. And so those of you who follow this know that in the aftermath of the 2008 economic crisis, an important banking regulation law, financial regulation law called Dodd-Franks was passed. And I think part of what we're seeing is not only that law has been weakened as it's been implemented and especially revised in 2018, but also that the law itself reflects the New Deal regulatory approach. And that approach really doesn't work for a 21st century economy. And as we're watching banks collapse, as we're being forced to bear some of those costs as a society in order to keep a more widespread financial crisis from occurring, we need to be thinking about how we can prevent this from occurring again, how we can draw the lessons, what we can do better in the 21st century. And I want to suggest ultimately regulating the financial sector is key to building a better economy, what I've referred to as democratic political economy, where my aim here is not just for everyone to have economic security. I think that's absolutely essential, but also for there not to be such large concentrations of wealth and social power that it essentially undercuts democracy. And so for the illustration here today, I'm cribbing from Nancy Fraser and Adam Tooze, who both like the Ouroboros, which is a mythical creature. Here it's represented as a dragon, often represented as a snake that eats its own tail. And part of what I want to point out to you, right, is that First Republic Bank collapsed a week ago. What happened to it? Well, JP Morgan Chase gobbled it up. That is to say, a big bank ate a little bank. And so as opposed to addressing the origins of systematic risk in the financial sector, quite to the contrary, it appears that the current crisis may in fact be further amplifying that risk. So let's get into it. I'm going to start, and this is really review, looking at what's happening in the banking sector. These diagrams are a little bit old from the last time we talked about this, but I just want to refresh your memories that we've got a number of mid-sized banks in the United States today that are in a sense in an unenviably vulnerable position where their asset of cash to non-cash assets makes them highly vulnerable to runs. And the result is, on the one hand, that the stock prices of these banks is being driven down, and on the other hand, that as the markets alert the people who have deposits and assets at these banks to the vulnerability of the banks, people are running these banks. How did they get to this unenviable position? Well, and here I want to say, it's not exactly the fault of these banks per se. they did in many respects what banks are supposed to do. They took the money that was deposited in them and they turned it around and lent it to others, as banks do. That's their socially valuable function. And then they invested in what were meant to be safe assets in order to backstop their operations, right? To have a floor, a safe foundation for their lending practices. And the assets they invested in were primarily US Treasury bonds. And the problem is that when interest rates went up, Treasury bonds lost value. And you can see this in all of these banks, right? That they went from having a positive to a negative ratio of unrealized gains and losses. And that directly reflects the fact that as interest rates went up, the value of older treasury bonds went down. People were more interested in the newer treasury bonds that were bearing higher interest rates. And so it devalued a critical asset class for these banks and then exposed them as being essentially insolvent. When we look at this from a couple different angles, the first thing I'll emphasize is that the markets figure out much more quickly than the people who have deposits at the bank, that the banks are vulnerable. And so we can see, right, these are banks that have been driven down in terms of their value over the last couple months. Please note, Silicon Valley Bank is not even on this diagram because it is no longer in existence, no longer a publicly traded company, right? And so now the same thing is true for First Republic, but this diagram is from late April. And so one of the things to notice here, and this is why we have federal deposit insurance, right? But that insurance is only up to 200,000. One of the things that's really important about Silicon Valley and First Republic is that the majority, and I think it's, you know, in those banks, 80% or more of their deposits were larger than the amount that the federal government insures. Having said that, that's true for about 40 to 50% of assets that banks own. So higher ratio of big deposits in these banks, but not outrageously so. But what I'm starting to say is the reason we have that insurance is because the vast majority of us, when we open a bank account, don't examine our bank's financials, make sure that they're sound and safe, right? We assume, well, it's a well-known bank, it's been on the corner for a long time, it's a safe place to put our money. And that kind of faith and confidence in financial institutions is essential. It's the lubricant that makes the whole economy function. Without that level of trust, people hoard their money, and then we have a liquidity crisis. Having said that, I do want to point out, right, so far we have had 3 banks fail: Signature, Silicon Valley, First Republic, right? And the number of banks that have failed in 2023 then is perhaps not that alarming. But when we start looking at the size of the banks that have failed, the assets that they held, the number of deposits, we begin to recognize that this is actually a significant financial banking crisis, right? And one way to see this is that in 2008 to 2010, hundreds of banks failed. But as this somewhat interesting diagram shows through a visualization, the vast majority of those banks were tiny banks, right? The only one that's comparable size to these banks is Washington Mutual. And because these banks are so much larger, the amount of money that's been lost in 2023, or I should say that the assets controlled by the banks that have failed in 2023 is more than half of the amount from the height of the Great Recession. And so this is a significant crisis that is currently playing out in the banking sector. Very quickly, and I'm not going to go into these details a great deal today, but what I want to point out is that the bank that bought First Republic, right? JP Morgan Chase was the only bank, it turned out, that had the assets, the wealth to absorb a failing bank and to make all of the account holders whole. JP Morgan Chase, as a result of absorbing First Republic, is going to get even larger, right? That's the eating the tail model here, right? And if we look at how big JP Morgan Chase is, we put it on the list of the world's 100 largest banks. Well, it's the 5th largest in the world. But if you look at the other 4, they're all Chinese banks. And that means that they kind of skirt the divide between being private banks and being state-owned banks, right? And so really, JP Morgan Chase is the largest fully private bank in the world. And it is huge. If you look at its assets, they approach $4 trillion. That means JP Morgan Bank is about as rich as a mid-sized European government is. It's a huge entity. And I just put this on the board. This is something I'm not going to go into in detail today, but I am thinking about and looking into concentration in the American economy right now. And what that means is large firms controlling large amounts of the trading, sales, service provision in the sector in which they work. And these diagrams produced by I guess distributed by the Federal Reserve show that in manufacturing, in retail, in wholesale, in services, in utilities and transportation, and in finances, in every sector of our economy, we've seen an increased concentration over the last 30 years. To put this in ordinary terms, there's a growing monopolization. And what's happening in the banking sector today further accentuates that trend. So now going back to the bank failures, just for a moment to understand why they're happening before we figure out what we can do about it. The primary cost, the thing that shifted the ground underneath these banks and took them from being liquid and solvent to being failing institutions, is the increase in interest rates. And here I do think the Federal Reserve deserves some blame for not acting quickly enough. And had it acted earlier, the increase in interest rates might have been more gradual. So as you can see, there was another 0.25 interest rate increase just a week ago. And we're now up in territory that we haven't been in for almost 20 years in terms of overall interest rates. But not only that, the rate at which these rates have been increased, the pace of increase, is really unprecedented. You can go back 30 years into the late 1980s, and every other time the Federal Reserve has increased rates. Yes, sometimes the rates go up higher, but they have never gone up as quickly. And so there wasn't enough time to plan, to absorb, to pivot for these financial institutions. And of course, the reason that the Fed is so aggressively raising interest rates is because inflation has taken hold, become stubborn, and the Fed misidentified inflation initially as transient, and it's not them alone, many people did. And now it appears that we have fairly persistent inflation. By the way, inflation is coming down, and two of the more important proximate or transitory causes of inflation, the supply chain problems caused by the pandemic, and the energy supply problems caused by the Russian invasion of the Ukraine appear to have been so far mainly solved. And you can look at the data here. Logistics no longer cited by most manufacturers as a problem. Energy prices are actually, I think, going up again, but they have been less important to the inflation story in 2023 than they were in 2022. And on the other hand, service costs seem to be really the most important driver of inflation in 2023. And that seems to reflect an insufficient labor supply. People are paying more in order to attract and retain employees. And the result is that those costs are being passed along, particularly in the service sector. And that probably means that inflation is going, or at least inflationary pressures are going to be present for a long time. You probably saw new jobs data come out recently, and that also seems to indicate that there's still inflationary pressure in the jobs market in the United States, in the labor force, and that creates generalized inflationary pressures. That means the Fed has to keep interest rates reasonably high in order to combat those pressures. That means that institutions like banks that have built their economic models on an assumption of low interest rates are going to experience difficulties for a while. That's not the only cause of banking problems, but it is, I think, the proximate cause, the short-term cause. So let's talk now about some more long-term causes. And some of these have to do with the way in which financial markets have been restructured in the 21st century, and the way in which governmental policy has, in a sense, been forced to meet financial markets halfway. And so I'm drawing here on a wide body of literature. I've spoken with you before about Adam Tooze, who I think is really illuminating on these topics, an economic historian at Columbia University. His book on the 2008 economic crisis, I think, is the most illuminating book on that topic. It's called Crash: How a Decade of Financial Crises Changed the World. And it's really not just on 2008, but the aftermath of 2008, which I think in many respects is generating the problems we're dealing with today. Then Mohammed A. El-Arian, who is a very well-respected economist, president of a Cambridge college, former member of Barack Obama's Council of International Economic Advisors. His book, The Only Game in Town: Central Banks' Instability and Avoiding the Next Collapse, came out about 5 years ago. And if by collapse we mean banking sector collapse, it appears that he's going to be quite prophetic. And so what Tooze and El-Arian and others help us to see is that for the last 14, 15 years, we've been in a near zero interest rate environment. And not only that, but the central banks of the developed world have been doing other things to increase the money's supply in order to prop up the stock markets and financial institutions. And the reason they've been doing this is a little complicated, but I do want to delve into it for a moment. They, I think, based on especially El-Arian's work, but I think many interviews, are not very comfortable being put in this position of having to take central bank policy, Federal Reserve policy, and use it to accomplish a broad social purpose, keep the economy humming, as opposed to a narrower purpose, which is more combating inflation and keeping employment at a viable level, right? And they feel like they've been put in this position in part because governments have not been willing to act. Legislatures in particular have been paralyzed and just relied on the central banks to bail them out, but also because of transformations in the nature of finance itself. And here I'm going to introduce the idea of the shadow banking system. And so part of what we concluded last week talking about is the idea of regulatory drift, that if we don't update our regulations to evolve as our economy evolves, our regulations may be trying to regulate in economy, social forces, commercial practices that no longer exist, or for which the regulations are no longer targeting the problems that are actually the current problems. And in the course of the last 30 to 40 years, financial asset management and the tools, the classes of assets have become much more complex. And a lot of financial activity has shifted outside of banks proper into hedge funds and various complex financial instruments that are not issued or managed by banks. And the result of this is that the regulations that attempt to secure the banking system are no longer securing the financial system or the money supply. And central banks are aware of this. And as a result, they feel that they've got to prop up the financial system as a whole, because if they don't, it can crash. And if it crashes, it pulls everything down with it. It's very destructive for our economy. The example that's often used here is what happened in the 2008 economic crisis, right? The impetus for that crisis, the catalytic event, was a collapse in the housing market in the United States. But that collapse quickly rippled out, right, into other financial institutions, not just in the United States, but worldwide. The reason that it rippled out is because, unlike the old model of purchasing a house, right, residential real estate, in which if you wanted to buy a house, you went to a bank, you got a mortgage. That bank, first of all, owned that mortgage, right? And because it was going to own that mortgage from issuing date to maturity date, it was doing due diligence. It didn't want to be on the hook for a bad mortgage. And because it owned that mortgage from soup to nuts, it also was regulated. And in being regulated, we successfully regulated, in a sense, the financial side of the US housing market. But around 25 years ago, banks started selling mortgages to people who chop them up, institutions, right, who chopped them up and sold them as mortgage-backed securities. And this did a couple things. It changed the incentive of the bank, right? It's not owning this asset anymore. It's not on the hook if it goes bad. So it's not incentivized to do due diligence. It makes its money by issuing the mortgage, not by seeing the mortgage to its maturity. It's in the bank's interest just to issue as many mortgages as possible. And so the banks started, when people couldn't qualify for prime mortgages, issuing a whole bunch of subprime mortgages, right? And then these supposedly safe assets, right, they've been issued by banks, they must be good mortgages, start circulating in the economy. Derivatives are based on them, other assets that are essentially just bets on the idea that these assets will ultimately mature and deliver what's promised, amplified the risk. And so there was this ramified risk that made its way out into the overall financial system. And on the other hand, the regulations, right, that said the banks have to have a certain ratio of assets to debts didn't capture this, because the banks didn't own the debt. The banks issued the debt and sold it and issued and sold, it was a revolving door in which regulations no longer kept up with the nature of the financing of the housing market in the United States. And this, among other things, put central banks, the Federal Reserve, in the position, if the government isn't going to regulate this, if the risk is widespread, of trying to keep the risk from dragging the whole economy down, right? And so in a sense, central banks were over a barrel for the last 15 years and doing things that were problematic from the long-term economic perspective, because of course, low interest rates can't last forever. Now that we're seeing those interest rates come up, what we're recognizing is that this was a sugar high kind of policy that is ultimately going to leave us vulnerable. That's part of why we should expect more banks to collapse in the future. This occurred in the era of financial capital, right? The last 30, 40 years, the largest growth sector in the American economy has been the financial sector. It's been deregulated. It's been shopping around for the regulations it likes best, whether those are in Delaware or London or Geneva. And the result is there's been a rush to the bottom. Everybody wants these financial corporations to be headquartered or issue their contracts in their jurisdiction. And so we try to minimize our regulations. That combined with near zero interest or easy money means that there's been a lot of leverage, a lot of companies and speculators going into debt because the money's all but free in order to finance new speculative, risky operations. This is what's got to work its way out of our economy. Now, this created an economic climate filled with moral hazards, in which essentially economic actors who are large enough to be systematically important are taking risks by going into debt or spending other people's money because they're deregulated, and knowing essentially the history that if we get into trouble, ultimately the federal government, the Federal Reserve, the central bank will bail us out. And so this has resulted in a split between the financial markets, which just have been going gangbusters, and the real economy, which has been moving along okay, but not doing very well for many people, and licensed a whole bunch of speculative investing. It has not produced sustained and inclusive growth, but a kind of growth that narrowly benefits the investing class. And this is not going to last. It is already coming to an end. So with that in mind, now let me give an illustrative case of why I think this is so problematic. And that's to look at what happened in the aftermath of the 2008 economic crisis, especially to the banks, that issued all of that bad mortgage debt that ultimately dragged the whole economy down. One thing is clear: the banks acknowledged malfeasance, right? And as a result, most of the large banks settled with the Justice Department and accepted large fines. When I say large fines, look at JP Morgan Chase, $13 billion fine for financial malfeasance. That sounds like a lot of money until you look at JP Morgan Chase's assets at the time, $2.5 trillion. It's almost double that now. And so really this is just a slap on the wrist. And here's the, I think, real issue. And that is that while they acknowledged malfeasance and paid a fine, nobody was prosecuted. Exactly one bank officer went to jail for this malfeasance, and he was a mid-level banker in Credit Suisse. He was not any of the big fish, right? And this man, Paul Pelletier, resigned from the Justice Department, where he was in the criminal division fraud section, in protest over the fact that nobody was prosecuted, and pointed out that in his 27 years of service, they had again and again and again prosecuted bankers for this kind of malfeasance. But in 2008, 2010, under Eric Holder, the word was essentially, we don't go after the banks, right? And Trevor Jackson, who's done, I think, a very good history of impunity in capitalism, points out that this is a recurring pattern, that during financial crises going all the way back to the late 17th century, bankers are not prosecuted, even if bankers are criminally responsible for the economic disaster befalling society. Why not? Because we need the bankers to help us to revive the economy. You can't bite the hand that feeds, right? And so Katerina Pastor, whose work I've been speaking with you about for a couple of weeks now, says all subscribe to the principle that all are equal before the law, and yet law often deals a better hand to some than others, right? This is clearly the case in the banking sector. Just a little bit more, this is Robert Kuttner, one of my favorite economic historians, writing in the New York Review of Book in April. He says, we live in an age of selected application of the law, in which influential people often evade responsibility for actions that are or should be criminal, while minor offenders such as shoplifters or drug users can face prison terms. Impunity is fundamentally inconsistent with democracy. And I think there he means the basic principle of equality under the law, but also that it generates unequal influence by making some too powerful. During and after the financial crisis of 2008, the degree of structural impunity in the US was pervasive and startling. And so I have on the board here Phil Angelidis, who chaired the Financial Crisis Inquiry Commission, noting that they made a bunch of criminal referrals to the Department of Justice, and the Department of Justice chose to act on none of them, right? Also, William Black, who was a banking regulator, who ultimately had hundreds of successful convictions during the savings and loan crisis of 1980s and 1990s, remember, late 1980s, early 1990s. And, noting that his agency made 30,000 criminal referrals during that crisis, and there weren't nearly that level, just dozens in 2008. And so, right, we are not doing a good job of policing our banking system. The result, on the one hand, is that bankers are taking more and more risks that are ultimately bad for our economy. And on the other hand, the widespread sense that this system is rigged, fundamentally stacked, such that bad actors not only skate away unscathed by their bad action that drags the rest of us down, but in fact profit. We bail them out while the rest of us are left to suffer from their malfeasance. We've looked at this before, right? This shows you that in the aftermath of the 2008 crisis, everyone was damaged, but the richest 10% saw their wealth decline less than everyone else and saw their wealth rebound, ultimately to the point where they were richer 5 years later, whereas the average family, the remaining 90%, did not see their wealth rebound over the subsequent decade. They're actually poorer today. Again, this shows you a little bit more of a breakdown. And as is often the case, the rich get richer, the poor get poorer. The people at the bottom of the economic distribution are the people who were damaged most. The people at the top are those who escaped damage altogether. Now, why is this? It has to do with asset classes. The people in the bottom 90%, the middle class and the working class, are investing their wealth primarily, often exclusively, to the extent that they have it at all, in owning a home. What was 2008? In the first instance, it was a housing bubble crisis, right? And so 10 million Americans lost their homes, 10 million, tens of millions more saw the value of their homes dramatically eroded. But if you're rich enough to invest not only in your home, but also in stocks, so that the majority of your wealth is not in your home, but in your stocks, and the Federal Reserve feels, in light of financial risk generated by the banks, that it has no choice but to bail out the economy through easy money policies, the stocks come back much more quickly than the houses do, right? And so this amplified the inequality of wealth in the United States, where 1% of the population owns 40% of the wealth, 40% of Americans own 1% of the wealth. It couldn't be more skewed than that if we were trying to create that skew. I've spoken with you before recently about Katerina Pastor, The Code of Capital. I just want to highlight this from the quote that I think captures the core thesis of her book, which is that people use lawyers. They use contract law and trust law and tax law and bankruptcy law. And when I say people, what I'm really referring to here is firms that can afford very expensive corporate lawyers to create contracts that protect their assets. They do all this to generate legal asset shielding devices that mean that they're not going to suffer when everybody else suffers. And then you also have the state's willingness to extend a helping hand to capital, right? You put those two things together and you get exactly what happened in 2008. Pastor gives us a long account of how this works. The central idea here is that there are these areas of law: administrative, contract, property, tax, trust, collateral, and bankruptcy, that together are complex, technical, and opaque. You get your credit card contract in the mail. Do you read it? Right? Can you read it? Right? It's 8 pages of legal gobbledygook in a tiny little font, clause after clause after clause after clause. No, you can't read it. Ordinary people can't read it. Ordinary people can't afford the complicated corporate lawyer who would probably tell you never to sign it, right? And so this area of law is unapproachable for ordinary people. It also has these additional factors. It is indeterminate and malleable. And so it can be used creatively to afford that legal sheltering, right? The coding that creates the asset shielding that Pastor refers to, that then is extended to more and more asset classes, right? Whether it's trusts moving from land to bonds to corporations to mortgage pools and derivatives, or bankruptcy extending from bonds to derivatives and private assets like repos. These are all new asset classes that have been created via private law creativity, right? And the result is that more and more of the economy has drifted into the shadow banking sector, a sector that is not regulated but functions essentially the way banks function, and that our regulations have just completely failed to keep up with this. The result is more and more inequality, more and more concentrated economic power, more and more financial risk, and we're more and more prone to economic crisis. Some of the illustrations, which we've talked about together before, issuing debt that, in a sense, the issuers know that it's very likely the person who has the debt is not actually going to be able to pay it on time, right? Credit cards, mortgages, student loans. We have become a debt-based economy, and right, extracting and consolidating that debt has become one of the main ways that financial corporations make their profit. What does that mean in practice? It means seizing your assets, either when you default on your debt or you go through bankruptcy, putting a lien on your income, taking your house or your car from you, cleaning out your savings account. We're also seeing, right, this thing that's happening with the bank failures right now, which is that the shareholders and the depositors, they get their profits when times are good. But when things go south and they're in trouble, the federal government, the Federal Reserve, the Federal Deposit Insurance Corporation comes in and bails them out, makes them whole, so they get their gains from their speculative behavior, but don't have to pay the cost because we're also dependent upon them, right? And then the idea that basically corporations shop for the regulations they prefer, move across the country or across the globe in order to find the least invasive regulations. And the result is because countries and localities, jurisdictions don't want to lose the business of having the company headquartered there or the contracts conducted there, we get a race to the bottom in which everyone is trying to have as minimum a regulation as possible. All of that to say, this is an economy that is increasingly unfair. As I started to suggest to you at the end of last week, it reflects an approach to regulation that grew out of the New Deal, out of the first third of the 20th century, that channeled populist politics, right, which was a movement directed against concentration of wealth, the corrupting influence of large fortunes. Yet it took it in a direction that made it less strongly protective of democracy. The New Deal regulatory state took what Sabil Rahman refers to as a managerial approach to economic governance. By the way, it didn't protect Blacks and women very well. It was put in place in a period of extraordinary economic growth, which meant that the pie kept growing, and so the distributional fights could be papered over for a while. But as soon as growth slowed down, as soon as Europe and Asia recovered from the damages of World War II, those fights started again, and the managerial approach very quickly was exposed as limited. So the managerial approach has a few features. First, the fundamental goal is economic growth, right? Rising tide lifts all ships. Let's make sure the economy keeps growing. The objective, the big objective, is to make sure that income and wealth that are generated by minimum regulation are more or less fairly distributed. And the underlying assumption is that corporations and the actors who run them are basically benign, that they want what is good for society because that's ultimately what is good for them. So they're just a few bad actors that needed need to be weeded out, not a more skeptical overall questioning of whether or not financial firms are actually usually on our side or not. And this more benign view of the way in which capitalists tend to operate in a democracy comes out, I think, of the experiences of World War I, World War II, the Great Depression, unifying events, as we spoke about last week with Robert Putnam's work. The sense that we're all in this together made it perhaps easier to trust corporate elites in the middle of the 20th century than it does today. When we get into the actual mechanisms of regulation, the New Deal approach relies on centralized, neutral, or apolitical, insulated experts, right? This is the Federal Reserve, right? They're appointed, not elected. Once they're appointed, the president can't tell them, the Congress can't tell them what to do. They make up their own minds. Similar things apply with many economic regulators, right? That they're civil servants, they're not political appointees. They're supposed to use their expertise, and only their expertise, to be objective and impartial, and hence not democratically accountable. And so we aim via law and the way in which we structure the regulatory apparatus of the administrative state to insulate governance against ordinary citizen inputs. We discourage citizen agency or activism. We camouflage or shelter regulatory activity. They're brief windows of comment, but the actual process of generating the regulations is done behind closed doors. And so one way of summarizing what Sabeel Rahman is helping us to see here is that we're replacing one accountable power, economic power, with another kind of unaccountable, democratically unaccountable power, and that is administrative power. So what are the limits to this approach? Clearly, it takes the value of growth for granted, and whether or not we're speaking environmentally about whether we can continue to have exponential economic growth. I was reading in the context of research I'm doing on environmentalism and climate change, an economist saying there are only two kinds of people who think you can have limitless exponential economic growth on a finite planet. On the one hand, madmen, on the other hand, economists, right? And so even if you're just looking at this from an environmental perspective, but if you're also looking at it from a democratic perspective, the idea of the consolidation of tremendous economic power is something we should be more suspicious of. And the result was that the democratic progressive movement was demobilized. Don't need to organize, don't need to unionize, you don't need to be active in opposing the gold standard. Don't worry, the experts will take care of it, right? And yet what actually happened is that over time, as growth slowed, as corporations became more assertive, as a new model of profit took hold, maximizing shareholder returns, the regulators became increasingly captured by the industries that they regulate, in part because they depend on those industries for getting information. And those industries were not benign public actors, but in fact serve their own interests, in part through things that are at least borderline corrupt, like the revolving door between regulators and the industries they regulate. If you regulate my industry for 5 years, you gain a whole bunch of expertise, you're going to be really valuable. I want to hire you. And by the way, your salary will go up, 5 or 10 times what it was from when you were working at the government. But I'm only going to hire you if your regulations that you've been enforcing on me have not been too damaging to me. And I think one of the things that Sabeel Rahman really helps us to see is that the Obama administration's response to the 2008 economic crisis, whether this is the Troubled Asset Relief Program, TARP, right, which bailed out the banks, or the Dodd-Frank legislation, which created a Financial Stability Oversight Council and charged them with not allowing too big to fail institutions, but didn't actually give them specific legal mandates on how to do it, that this was a continuation of the New Deal expertise, managerial, minimalist regulation model in an economy in which it really didn't make sense anymore. So what are the alternatives? And here I'm going to draw on three people who are in leadership positions in the administrative state in the Biden White House. Actually, Tim Wu of Columbia University Law School just stepped down. And let me give you the position that he stepped down from. He was the special assistant to the president for technology and competition policy for the first 2 years of the Biden administration until very recently. Wu wrote a book. I don't know if you would recognize the title. The Curse of Bigness is actually an essay that Louis Brandeis wrote in the early 20th century. I think published in The Atlantic in 1910 or something. And Wu took this as a title for a book he published a couple of years ago, Antitrust in the New Gilded Age, really arguing for breaking up big corporations, especially in technology and media. Lena Khan, whose books are not here because she's been a law school professor also at Columbia, mainly published articles, but considered one of the leading, quote, neo-Brandeisians, somebody who also is very skeptical of the level of concentration of wealth and power in the corporate world today, is the head of the Federal Trade Commission. And she's very young. And I think it's really a quite radical appointment. And then Sabeel Rahman, who I've been referring to, especially this book, Democracy Against Domination, but also Civic Power, Rebuilding American Democracy in an Era of Crisis, really getting into the tall grass of administrative law, and that it makes sense that he has been appointed the senior counselor in the Office of Information and Regulatory Affairs. He was actually its acting director until a couple months ago when a full-time director was confirmed by the Senate, I'm sorry. And I imagine, like me, most of you had not heard of OIRA, right? The Office of Information and Regulatory Affairs. But apparently, this is one of the most powerful institutions in the administrative state, in the sense that it is the office that regulates the regulators, right? And if you were paying attention to this under the Obama administration, Cass Sunstein, now at Harvard Law School, long time at the University of Chicago, was the director of this office. And he did all that nudge stuff, if you're familiar with it. But Sabeel Rahman has been in charge of, I think, a really important effort here. And again, very technical, not getting a lot of attention. But there are two what are called circular documents. And these are documents that are given to every other regulatory agency and instruct them in how to craft new regulations. These are the values that have to guide the revision of regulations, the elaboration of regulations. And so this is regulating the regulators. These two documents have an effect that radiates out on the whole American administrative state. They hadn't been updated, I believe, since the beginning of the 21st century. So nearly a quarter century of regulatory drift and stagnation here. And Rahman and colleagues have updated them. They're still in the comment period, that they have more work to do before this will become final. But and again, I don't want to be too detailed about this, too fine-grained. They are changing the way in which time discounting works, right? So how much should we prefer present advantage to future gain? One of the effects of too much of a discount on future gain is that we basically don't weigh it in making regulations at all. This was the Trump administration's approach to environmental regulation. If you have too steep a discount rate, essentially, if it doesn't have a net effects in the next few years, then you don't take those effects into account at all. So as you might guess, the Biden administration is handling this very differently and creating a set of guides for future regulations that require us to pay much more attention to the future. Distributional sensitivity, not just is this regulation good for the economy as a whole, but how does it impact people at the bottom of the economic ladder? If it creates more wealth, but all that wealth goes to the top 10%, that's not a good regulation because the top 10% don't need it. And especially if it's bad for the bottom 50%. And it's kind of, I guess, scandalous, but indicative of how badly out of date our regulatory state is, that this wasn't already part of the way in which regulations were evaluated. Also taking into account global effect. Now, to conclude today, I want to go back to banking and the financial sector more broadly. Give me just a couple minutes and I'll wrap this up. But the limits to the managerial approach, I think, have been painfully obvious for at least 20 years now. That's the old New Deal minimalist approach. There are financial limitations. They have not kept us out of the return to the boom bust cycle. Please note that the more aggressive financial regulations in the middle of the 20th century kept us out of banking crises and deep recessions for more than 30 years. As those regulations were eroded, we've started to return to deeper recessions and more frequent bank failures. There's also a democratic problem here. This approach allows for the accumulation of economic power that is incompatible with the political equality of all citizens. And so even if it were good for the economy, if it's bad for democracy, my guiding approach here, democratic political economy, suggests we should try to produce an economy that is supportive of democracy. Finally, in terms of its limits, there's a political and administrative limit. Relying on experts who are insulated from public influence has allowed the regulators to be captured by the interest and industry they regulate, and this has produced widespread mistrust in government and expertise. I was reading Raman's book, and there was one passage in which, it's written in 2016, he's talking about skepticism about scientific and medical regulation. And it just jumped out to me. Here he is in 2016 predicting, in essence, if we have a pandemic in the 2020s, a lot of people are not going to trust even medical and scientific regulators because they've become so alienated from the administrative state. They don't trust the apparatus as a whole. So what should the orientation, the alternative orientation be? Channel finance into productive investments. Link long-term capital flows to short-term credit needs. That's the core value that our financial institutions play for the economy as a whole, as opposed to speculative investors. Provide socially useful forms of credit, like allowing middle-class people to buy homes without forcing them into highly disadvantageous mortgages. Recognize the temptation to use the assets that financial institutions attract to leverage speculative gains, right? Brandeis's other essay from the beginning of the 20th century was called Other People's Money. And it was noting that the banks were taking ordinary people's deposits and using them to speculate in stocks, not in the way that we want them to provide credit for financially constructive activity. And be highly attentive to the risk of highly concentrated social power as an instrument of anti-democratic domination. We don't want too big to fail, too big to jail institutions in our economy. And so there are a whole bunch of regulatory ideas here. I think I should probably just very briefly mention them and then open things up to questions. I can see David already has his hand up, and I know I'm running out of time, but we need to render finance compatible with democracy. And that means the equal influence of all citizens over public policy and not empowering the arbitrary will and impunity of a particular sector of our economy. That almost certainly means aggressive anti-monopoly legislation. Make sure that there are no financial institutions that are so large that they can hold the economy as a whole hostage. The figure that's often held out here is that they should never control 10%, more than 10% of their sector. Draw a clear line between socially valuable and risky or speculative financial innovations, and ensure and backstop and support the socially valuable banking functions, but divorce them, decouple them from the risky financial innovations. Make it clear by reviving the line between commercial banking and investment or speculative banking that we're not going to backstop the speculative banking. That's right, reinforcing the line between commercial and investment banking. Really try to make sure that there is regulated competition and bounded accumulation. Reasonable profits, that's okay, but discourage the idea that the economy should be a risk, or I'm sorry, norm-free zone, that anything goes, that this is the Wild West. As much profit as you can make it. That's become the reigning ethos of 21st century capital. That needs to be reined in. Reduce complexity, because it makes regulation very hard, and maybe even treat finance as a public utility, right? In the 21st century, not having a credit card, not having a mortgage, not being able to go into credit card debt, not being able to use debt to purchase your car makes it very hard to be a full equal citizen. In the same way that we need electricity, that we need roads, that we need sewage processing and water treatment, we perhaps need to think of financing as a public utility, and hence regulate it in the same way that we regulate other public utilities. All right, I will stop there. My main point is that there are lots of good ideas for increasing financial regulation. Having said that, Biden appointing the dream team by itself is not going to do it. Congress needs to act. And then we're back to the old hard chestnut. How do we get anything through Congress in the 21st century? David, start us off. Thanks for waiting.
Well, I'm sitting here feeling increasingly guilty because in my retirement, I've done nothing but invest in this system and created more wealth for the 1% who don't need it anymore. And I'm asking myself, all the suggestions you made for actions we should take are either social or political in their emphasis. And I'm sitting here thinking, what can I do as an individual so that I don't end up, feeding this evil system? And it strikes me that our investment power, and we are we are the people in society that have the most expendable capital for investment. Are there ways in which we can address this individually or perhaps collectively, but short of government intervention, which I'm pretty skeptical about, or some kind of social movement that would point out to people just how invidious and evil this downward spiral of, or this upward spiral of giving more and more to those who need less and less, this spiral we're in. And I'm hoping that maybe in the future we could address other initiatives that aren't so global and dependent upon political action, for which I think there's lots of evidence that we should be skeptical about whether or not that will end up making a difference.
Well, so I'll say two things, David, and I'm going to start by going head on with your concluding sentiment there, which is that we should be skeptical of the idea of state action. And I'm of the opinion that we should be skeptical of the instruments of state action that we have relied on for the last 100 years, right? And I'm going to speak more about this in the future, but part of the problem with those instruments of state action is that they've been, and here I'm talking about the regulatory apparatus of the administrative state that grew up in the United States beginning in the 1930s and has become, in a sense, by itself almost a fourth branch of government, right? And so I think it's been highly insulated from any mechanisms of political accountability and increasingly captured by special interests, especially the very industries that it's meant to regulate, right? And so I agree with you up to that point. Where I disagree with you, I think, is in suggesting that this is and always has to be the case, as opposed to the idea that we could generate different instruments for regulating the economy, make them more democratically accountable, less susceptible to capture, and more aggressively democracy promoting and public good promoting. And you know, what Sabeel Rahman and others do is go back to late 19th, early 20th century experiments and point out that there was a different direction that the progressive movement in the United States was moving in. The New Deal was a huge success, and in another respect, a disaster for that movement, because it displaced that movement's energy and absorbed it into a much more minimalistic managerial approach to regulation. So with that to the side, what can you do without waiting for the regulatory revolution that may never come? Right. And I think that's a good and fair question, even if I don't agree with the ultimate premise. Are you working with the people at Piedmont Garden that are working with Third Act?
Yes, indeed. I'm chair of the Climate Action Committee, co-chair with Dale Edmondson. So
Right.
yes, and we are considering, you know, moving our money and our credit cards and things like that. That's going on. But even that, if we just move it around within the same system, aren't we still captives of that system? And aren't we still, you know, just changing which particular institutions benefit from our investment? I just don't know whether moving from one bank to another, even though the second bank claims to be environmentally sensitive, is going to solve the problem. I'm going to do it. I am doing it. Yeah.
Yeah. So by itself, it's not going to solve the problems. I was just throwing that out as an example. By the way, I didn't integrate it into today's lecture, but I did a little bit of snooping around while I was looking at, you know, the fact that JP Morgan Chase is absorbing First Republic, getting even bigger. Who's the worst culprit for financing carbon capital? JP Morgan, right? And so the biggest institution is getting bigger, and all the more powerful to do the stuff that may ultimately destroy the planet. But having said that, yeah, I think you have to be really careful here. And so look to the small credit unions that have a community-based purpose. And because you're in Berkeley, California, I think you may actually be able to find them. But having said that, that's just one element of the problem. And this is where I think, in a sense, the idea to do things on our own is really important, but also limited, right?
Right.
Important.
I did find one organization called Americans for Financial Reform, which looks like it's doing good things.
Good. And I want to be a little bit, exculpatory here for you. You can't by yourself change the overall political economy of America in the 21st century, right? And not only that, you shouldn't therefore do things that are self-damaging, right? I could tell you to put your money in your mattress, right? But obviously that means in an inflationary environment that you're losing money and vulnerable, right? And so yes, you do want to do things that protect yourself and your interests. And in a sense, you're hemmed in when the overall economy and the overall regulatory state have been captured and perverted to the point where they no longer seem to do good. You can make money from them, but then I guess in some way I also want to say you should make sure you're doing some good with some of that money. And so if the problem here is not just that the financial system needs much greater 21st century regulation, but also that it's generating inequality, right? What could you be doing in your own backyard to promote greater equality? To be looking at the people who are really victimized by this, the people who lost their homes in the mortgage crisis and who are now, as Matthew Desmond teaches us, incredibly vulnerable in terms of housing insecurity, and the way in which housing insecurity is so disruptive, especially for children, right? And so to be thinking concretely, okay, I'm doing well enough that I can be perhaps a little bit generous. Where should I direct that generosity to do the maximum good and maybe counteract a little bit of some of the ways in which the wealth that I have depends on a system that has bad effects. Make sense?
Yeah, thanks much.
Yeah, thank you, David. Great question. Iris, go ahead.
Yes, I understand that our legislative bodies at the federal level work 3 days a week. They come in on a Tuesday, they leave on a Thursday. Now, this is a very complex financial system, and we're asking them to take hold of something they don't understand and aren't even in Washington, D.C. to hold conferences and talk across the aisle on anything. So if I'm terribly skeptical of change, it starts with the fact that our representatives aren't in Washington, D.C. doing the work.
But Iris, you've got to leave them time for fundraising.
You got it.
So first thing to notice, right? And again, I think part of the problem here, and it's why, and I'll speak more about this I think the next lecture. The proposal here is ultimately to open the administrative state to much greater citizen mobilization, to actually make it a target, to say, if we channel all of our political energy into making sure that Trump doesn't win the next election, well, yeah, we protect ourselves from this narcissistic cancer that has been plaguing our society for a while, but all of our political energy has gone into something that frankly is not likely to produce much by way of positive results, right? Couldn't we actually construct the administrative state in a way that invites and catalyzes more constructive political action that channels our political action into a more empowered and responsive direction. I think we have to be honest about the fact that Congress people, our legislature, is not doing most of the work of making laws and regulations in America in the 21st century. On the one hand, the professional staff of the people we elect are there 5 days a week, and they're the ones most of the time with the expertise that allows them to actually do what we want them to do, or else they're beholden to industries and special interests, and they're doing what those people want them to do because that actually lines them up for a much more lucrative career in the future, right? On the other hand, even when Congress is making good legislation, let's say Obamacare, the Affordable Care Act, right? It creates very general directives, or Dodd-Frank, the banking regulation, and then it turns them over to administrative agencies to flesh out what they actually mean. In many respects, that's where the legislative action is in the United States, and our economy and society are so complex and shifting and moving so quickly, we have to rely on administrative agencies to do this work. It's why it's so important that we also have to make them more democratically accountable than they are. So, you know, I think, Iris, your and David's questions in a sense dovetail. Act locally, act directly when you can, but then also find more effective avenues of acting politically when we want to change state policy. I know these are big idealistic ideas, but I'm encouraged by the fact that Joe Biden actually brings the people who are authoring these ideas into his administration. And I think we're at something of a crossroads in American politics right now. So many people are so angry, so alienated, so aggrieved. And either that you know, anger is going to be channeled into anti-institutional populist authoritarianism, or it's got to be channeled into reform, right? And yeah, I think you know where my money and hopes are. It's on finding an alternative to the populist authoritarian articulation of anger and alienation. Flossie, gotta unmute yourself. Go ahead.
You hear me now?
Just fine, thank you.
Yes. Can you give us a list of those organizations to which you contribute a monthly check? Because when I open up my mailbox, I get 20 invitations to contribute to worthy institutions. Okay, do I begin with the Alameda Meals on Wheels, or the National Democratic Society, or the Economist, or Planned Parenthood, or ACLU? Where do I begin?
So my answer to that question, Flossie, is going to be easy. I almost never give, and that's not because I'm ungenerous. It's because I'm poorly paid and getting a kid through college right now, right? I'm teaching at a tuition-dependent small liberal arts college. We just got our pay raise for next year, our cost of living adjustment, I should say, 2%. The increase in the cost of living in the New York City area where I live is more than 10%. So I, in effect, just got an 8% pay cut. I'm not crying poor. I'm sending a kid to NYU, and I'm managing to do it, and that's not cheap, right? But that's where my money goes right now. When I have a little bit more money, I do what I recommended to David to do, which is I tend to look in my backyard and see which organizations I think are doing the most good for people that I can actually see. I would like to actually participate in the organization, whether that means just handing out food or going to court with somebody one day a week to make sure that they understand the situation they're in and the rights that they have, that I would like to contribute to that kind of organization. I've given, for instance, to the Southern Poverty Law Center because I think they do very good work in combating, for instance, disenfranchisement. So I'm less inclined to give to the Democrats. Not that I don't think that that's important, but I'm inclined to think that my contribution is not going to get much bang for its buck. I give sometimes to the school that my son went to because I think it does good work in creating an inclusive, diverse educational community, and that the kids that come out of it are going to be good future citizens. Those are the kinds of places I'm looking, but I'm not here to tell you who to contribute to. Just do your homework, really make sure that you're getting bang for your buck, and hopefully that you can actually open the hood and see what the organization is doing because it's in your backyard and transparent, and maybe even welcomes you to participate in it. No, that can be hard, but that's what I would encourage you to do, Flossie. Another great question. Thank you. We've gone quite long. I'm a little hesitant to go any longer because I've got to be able to get this recording out to Amy so she could make it available to the people who couldn't see it live. And when it gets too long, that's hard to do. I'm going to join you next week from Prague, where I'll be giving a paper at a conference. Looking forward to being able to change the background for you next week. You guys have good weeks. Take care, everybody, and see you next Saturday. Thanks. Bye-bye.
Thank you.
You bet. Take care, everybody. Bye-bye.